Welcome back to Small Caps, ladies and gentlemen. My name once again, Kerry Stevenson. Today I've asked John Adams to come and have a conversation with us because we are looking at a very volatile market. People are asking lots of questions about how to protect and grow their wealth in these crazy, tumultuous times that we see. He's the chief economist for As Good as Gold Australia for all things precious metals. He has views on precious metals as well. Silver price has been smashed. We'll ask him about that. We'll ask him about, are we in hyperinflation, stagflation? Where are we going? John Adams, great to see you. Thank you so much. I know you're a busy guy. Really appreciate your time on Small Caps today.
Thank you, Kerry, for having me.
Well, John, let's start off, I guess, with a more of a macro. We'll get into the precious metals in a minute. Mm-hmm. But you've been a policy advisor of governments in the past, and you've got a view on where we're sitting at the moment. Clearly, as I speak to you now, our interest rates have gone from 0.1 to 0.35% here in Australia. Mm-hmm. There's a lot of nervousness out there in the marketplace at the moment. Where do you see things going?
Sure. Yeah. So now, what I will say is that, so where do I think I am now? I mean, I think we are in the midst of stagflation, both in terms of Australia, but in terms of around the world. And fun enough, only in late March did the RBA go before the Australian Parliament and say, the Deputy Governor said, no one could have foreseen the amount of inflation that we're seeing at the moment. And yet I was doing numerous interviews back in 2020 when they announced the record stimulus package in response to the COVID-19 pandemic and said, this is going to lead into an inflation disaster. And I did a number of videos titled Stagflation. So whereas the RBA couldn't see it, I mean, me and a few other smart cookies could see it 2 years ago, and obviously now it's coming into full fruition. And so, so obviously the RBA has raised rates, as you say, to respond to the record official inflation measured by the Australian Bureau of Statistics at 5.1%. They obviously need to restore credibility because, one is they're losing the fight of inflation, and cost of living is a really big deal, particularly when the official inflation is at 5.1%. Now, the 5.1% is driven by both some structural factors, particularly say in the cost of housing or in terms of education, but also some temporary factors, i.e. the war in Ukraine and how that's affected the oil price in terms of energy prices. But I have to say that the RBA has really shot itself in the foot, because the governor last November continued to say that rates would not go up in Australia until 2024, and a whole host of people across the economy entered into large, significant mortgage contracts to buy property. And part of those decisions were, in part, they set their expectations based on what the RBA was saying. So a whole bunch of people thought to themselves they could enter a large mortgage and afford the series of repayments over the next few years, and then once rates start to go up, they've got a bit of time to prepare themselves. Whereas now they've raised rates once in May, and even ANZ and Goldman Sachs are saying that we're going to see 8 rate rises between now and Christmas, which would basically cause enormous grief for hundreds of thousands of households across the country that have borrowed way too much money. So that's, I guess, where we're sort of headed in terms of the local reality. Obviously, we've got a week and a half until the federal election.
Yeah.
I mean, like, one of the really important and fascinating points was at the leaders' debate last weekend, the first question was about inflation and the cost of living, and neither one of them, Morrison or Albanese, was willing to talk about the RBA, monetary policy, too much debt, too much credit, and they were just talking about how can they use taxpayer dollars through fiscal policy to alleviate some of the challenging items that people are finding expensive. So whether it's about petrol or housing or childcare, they really were talking about short-term band-aid solutions rather than addressing the fundamental point. So we do have an inflation problem in Australia, but also around the world. And a few hours ago, President Biden gave a press conference talking about inflation. And why did he speak today? It's because so we're speaking Wednesday lunchtime. By I think 12 to 18 hours from now, we'll see the CPI being released in the United States. And I mean, the last year-on-year reading was 8.5%. So the fact that the president did a press conference before the release of the statistics, I think it's going to be a bad number. Could well be 9.5%, 10%, and that will obviously be a big factor as the Americans are heading into the midterm elections, and inflation is the number one issue. So I mean, central banks are trying to raise interest rates, trying to get on top of this inflation problem. But the real big challenge, Kerry, that central banks have, whether it's the RBA or the US Federal Reserve or others, is that unlike, say, the 1970s, the amount of debt we have in the system, households, corporates, and government, on top of complex financial instruments, derivatives, etc., there is so much more financial risk in the Australian economy that, in my view, there's a limit to how much interest rates can go up before financial stability is threatened. So think about where we were in 2019. The official cash rate was 1.5% in Australia, and in the United States it was 2.25%. And now they're trying to say to us, well, over the last couple of years, the amount of debt has just exploded across all sectors of the economy, and somehow the RBA governor is trying to sell us this point that the neutral rate is 2.5%, and that's where we're going to go. I just don't think that mathematically sticks up. So what I'm anticipating is going to happen is that while we're seeing a crash in asset prices, stocks, in terms of crypto, some various commodities are falling quite aggressively, but also we're starting to see a massive turn in sentiment in terms of property. I think that phenomena is going to continue up until the point in which the banks start to get into danger zone of some sort of systemic crisis, and that's when the central banks are going to pause. And that's when they have to start cutting again. And when they cut, in the Australian context, I wrote an article for my website, Adams Economics, in February, and I said that we're likely to see negative interest rate probably by 2024. So one of the big important issues for Australians watching this episode is that APRA, the Australian Regulation Prudential Authority, last year released a draft paper about preparation for negative interest rates, and they released the final expectations in about November, October last year, and they basically said to the banks that by October 2022, you must be fully operationally capable of implementing negative interest rates across all of your technology platforms and all of your sort of products that you offer to customers. And so why would they do that if everyone's concerned about rising inflation and rising interest rates? It's because I think APRA really let the cat out of the bag. So that's why I think we're going to see over the medium term ongoing stagflation. We're likely to see, if we have negative official interest rates, we're likely to see mortgage rates at a much lower rate than where we saw them last year. So think about in 2021, mortgage rates were about 1.8, 1.9%. I wouldn't be surprised if we saw mortgage rates at close to 1% in a couple of years' time, and that's going to further see an uplift in terms of property. But the real question about all of these topics, Kerry, is it's not economics, it's politics. And the political question is, will the politicians, the bureaucrats, and the leaders of the banks and industry, will they allow interest rates to go so high that they're going to lead their economy into the greatest depression in terms of in terms of our case, and in terms of Australian history? We've got the biggest debt bubble since the European settlement, and if they raise interest rates too high, particularly in the Australian context, I mean, most international banks lend about 38% of all their debt to the household sector. Australian banks are on the hook to about 60% in terms of mortgages and private sector debt, in terms of household debt. So any concerns about the solvency of households and collapsing property prices, that's just not going to affect households and the property sector. That is a direct nuclear strike against the banks, and basically all of our policy frameworks and all of our politicians and bureaucrats are focused on financial stability, and so that's why I think we'll see rates go up, pause, come back down, and we'll see ongoing inflation problems over the next 2 or 3 years.
But actually, John, what they should be doing is allowing those interest. I agree with you. I think the interest rates will go up. There'll be a sort of oopsies. We're going to head towards a horrible, not just recession, potentially a depression. Let's bring them back down. But what they should do is they should let the market rearrange itself, because this is all, I guess, a little bit staged, if you like. So it's a constant fight against letting market forces do their own thing, because will the bubble just keep getting bigger? In other words, will they just keep printing their way out of issues? Because you're saying interest rates are going up and then they'll go, well, can't do that. Back down they go again.
Yes.
Why won't they let market forces dictate the interest rates to go to what I call a normalized level?
Well, why? Because households, in particular in terms of the Australian context, will not be able to afford interest rates at normalized levels. And so now, obviously, as rates start to go up, now, I mean, I'm happy to quote my co-host, Martin North, from Digital Finance Analytics. I mean, at the current rates of interest, his data set suggests that 42% of households are in mortgage stress on a cash flow basis. So if rates start to go up aggressively, I mean, you could see 50 to 55% of people in mortgage stress. Now, that then will turn into delinquencies and potential default. And so while the banks can handle a small percentage of mortgage holders defaulting, once it gets to a critical mass, and I don't know what the precise number would be, but that critical mass that would threaten the solvency of the banks, that's basically that could lead to one bank collapsing, leading to a whole collapse of the financial system, kind of like what happened with Lehman Brothers in terms of 2008. So the reality is that rates can't normalize to their natural level, because it would trigger a critical mass of households going into delinquencies and defaults and threatening the viability in terms of the banking system. So the only thing you can do, and given that politicians are short-term thinkers, and I used to work for one,
yeah, I know.
All they just want to do is win the next election, and all they can do is play the short-term game and keep the bubble going. I mean, I remember a vivid conversation I had with my former boss, Senator Sinodinos, in 2015, and I talked about the normalization of interest rates and coming to terms with a step bubble. Yep. And he just told me point blank, we can't win an election if we do that. Even if it's the right thing to do, we just can't win, because Australians won't forgive politicians for collapsing the property market. And so that's the ultimate political inside calculation that they're making, that a depression, even though it's the right long-term objective. Yeah. Now, I will say some policymakers are deeply concerned with the short-term ramifications. So, obviously in the Great Depression, Australia saw the second highest rate of unemployment in the world, behind Germany at 32%. And a lot of Australians suffered significantly, both in 1929, 30, 31, as well as in 1892, 1893. So that level of economic disaster. Now, because we've got the biggest debt bubble since European settlement, the disaster this time around would be bigger than the two previous depressions, and both the economic cost, the political implications, the social, mental implications as well. Some policymakers says that the cost is too big, and we're better off going through inflation, even though I think in the long term, inflation is a much more deadly killer in terms of the economy versus in terms of a deflationary crash. But yeah, so I think at some point inflation is going to get way too out of control that they will have to try to rein it in. Otherwise,
but how do they do that, John? If inflation does get out of control, the only way to bring inflation back into some sort of normalized level is to raise interest rates. Isn't that the only option?
Yeah, yes. So you are correct. Now, so what I think the system will allow inflation to run, but whether they would allow hyperinflation like what happened in Germany, I'm assuming that the powers that be in the Treasury and the RBA have enough common sense not to allow that phenomena to occur, because if that were to occur, it would be a huge disaster if we went through hyperinflation. So one could only hope that they're pushing us towards the brink of disaster, but as they get closer, they'll realize that hyperinflation is a worse outcome than a depression, and they'll basically pull the trigger and just say, well, we're going to push the economy into a deep recession. So, but in the short term, I don't think they're willing to contemplate that situation. And even I think it was the deputy governor of the RBA in late March told Senate estimates that there is no conscious or purposeful plan to crash the economy. So they said it's not what we aim to do, and it's not what we want to do. And even if you listen to Jerome Powell at his recent press conference, when he raised interest rates by 0.5%, he said we'll continue to raise rates subject to economic and financial market conditions. So he's already given himself an out to say that there's a limit to what we can do. And once we reach this problem of financial market instability, that's when we have to stop. So far, if you read the tea leaves, that's what policymakers are suggesting. And when it comes to investments, you can either have a balanced portfolio approach, a deflationary geared portfolio, or an inflationary geared portfolio. Or given my medium-term macroeconomic forecast, I've got a very inflation-focused portfolio allocation at the moment.
That is a fantastic segue, because that's exactly what I wanted to talk to you about, is how do people protect, but not only protect, grow their wealth during these interesting times. And it is a cycle as well, John. We all know that this is cycle, but this one, back in the 90s, we had the recession that we had to have. What I would like to know is, you're the chief economist for As Good as Gold Australia. So clearly you've got a view on precious metals, but it's not just all about precious metals. You mentioned a moment ago that some commodities have been dropping, but there's a supply demand gap there as well. So what is John Adams doing in terms, or what would you suggest to people? And by the way, ladies and gentlemen, this is not financial advice. This is John and I having a conversation about what he's doing and what I'm doing. Please talk to your financial advisor, get your own, do your own research and get your own advice. But John, what is your view on what you're doing? How are you protecting what you have?
Sure. The really interesting thing I would say, Kerry, is that, and I'll just speak from experience, is before you even contemplate in terms of where to invest your savings, the first thing that has to be done is to give yourself enough financial buffers that if something goes wrong, you can weather that storm. So a whole host of people across the economy in the last 2 years, particularly with the COVID-19 management, just did not have enough buffers. They lost their jobs. They weren't able to return to work because of a whole host of factors. And a whole bunch of people went through enormous, mental stress, relationship breakdown because of money problems. Now, independent of precious metals or, what else that I've invested in, I had a very solid foundation in terms of when I entered the pandemic. So I had no debts. I had a couple of properties. I had sufficient cash flow. I was lucky in the sense that I run an online business from home, and I was able to continue running that business while a lot of people, were not able to work from home. But because I had savings and no debt and cash flow buffers, and I had forward paid a number of expenses, which I tend to do quite a bit in order to ensure that any major expenses coming up that we've all covered. It was all of those things gave me the ability to go to sleep at night not worried about money, even though there's millions of people across Australia that were worried about money. So I would just say that anything you can do to give yourself a buffer, so whether it's additional savings or improving your cash flow or
but John, sorry to interrupt you, but John, what we've seen a lot of people, because there've been what I call the stimmy checks going out to people. We've got the lowest unemployment rate for some time, and it appears to me that a lot of people have been paying off their mortgages in advance and they've got savings. So Australians do seem to be not recovering, but managing quite well, even under these challenging times.
The thing is, so the only thing I can say to that is that, so it's true, Kerry, that some have, but I would say a lot haven't. So if you, for example, go back to Martin North's data set on mortgage stress, I mean, pre-pandemic, the mortgage stress was at 32%. And even today, when we've got record low unemployment, mortgage stress is at a record high at 42%. So, and again, if you want to question the quality of Martin's data or other data sets in this area, feel free to. But for a lot of people, they are much worse off in 2022 compared to where they were in 2019. Now, I grant you, some people have played their cards well and they are doing extremely comfortably, and they've been able to build some of those buffers, but a lot haven't. And the other thing I would say is that even if some households have prepaid their mortgage down and they have some buffers, the two factors which would be impacting their current position is inflation, which means that it's more expensive in order for them to pay things up, but also in terms of interest rates. And so there could be certain people with a mortgage that have paid down, but if rates are going up and the repayments are going up, they could be facing additional cash flow pressure. So again, all I'm saying is that the best thing to do is to ensure that you've got sufficient buffers so that no matter what situation comes forward in 2022, 2023, that you can weather those storms without getting too concerned about your financial position. Now, once you have those buffers in place and you do have some savings in which to allocate to generate a return, well, then you have some in terms of interesting options. And so ultimately the first question will be that people have to consider is, well, what's your outlook on the macroeconomy? Is it inflation, deflation, or you're not sure? And if you're not sure, having a balanced approach would be, the right way to go. And pre-pandemic, I had a pretty balanced portfolio. I had some inflation hedged assets, and I had some assets that would be suitable for deflation. But then once
and what are those? Sorry, John. What are those? What are those assets that you have that are inflation hedged or deflation hedged?
Sure. So basically property and precious metals tend to perform quite well during an inflationary period. And then obviously in terms of deflation, particularly having physical cash that's independent of the banking system. Because when you have deflation, what happens to the real value of cash? You can buy more things with the Australian dollar because prices of everything else is going down. So if you have a deflationary crash and property is half price, it basically means you need half as much amount of cash in order to buy the property. So large cash reserves generally are a good thing. Sometimes people are interested in buying high quality corporate or government bonds that would be suitable in a deflationary environment. But they're the sort of general factors that one should consider. So I had a combination of all those things. And obviously, if you believe that deflation is coming, the best form of insurance is to have no debt, because in deflation you have high unemployment. It's hard to find work in a deep recession, and if you have big debt obligations, well then you've increased your chances in terms of defaulting. So I had that sort of balanced approach, and then once in March of 2020. We had a centralized, a coordinated series of press conferences by central banks, basically saying, if you read between the lines, that they were going to do QE to infinity. Well, yeah. I changed my perspective at that point and said, well, it's going to be, they've chosen the inflationary path. It's going to be stagflation. And then I started to, for example, liquidate some of the cash I had, buy more precious metals. I actually went into debt in 2020, and not by a significant degree, but there was a number of mining stocks that I thought were at record prices in terms of their cheapness. So I was able to snap some of those up in about, I think, May, June of 2020. And then over time, I've been able to pay that debt down. And so again, debt's not too bad in an inflationary environment, as long as you don't have any problems with cash flow obligations. They're some of the techniques that I've implemented, and so far that approach has been going well. And obviously, with me, I've got a family to provide for, and kids are not cheap anymore. And
They're not.
so yes, I've got two daughters.
By the way, ladies and gentlemen, he's just had a newborn, so he's got 3 now. So yes, he's got his hands full, as does his wife. And so we hope the newest one to the Adams. I love that, the Adams family.
Yes. So,
John, I want to move on to precious metals, because I know you like precious metals, but there's a lot of people out there that say doesn't give me a return, don't really care, and on top. And when we talk precious metals, there's platinum, palladium, silver, and gold. And you've been fairly vocal about liking silver, but silver has become the dirty kid in the corner at the moment. It's been smashed time and time and time again. And a lot of people probably a year ago were saying, oh, we love silver. Silver's going to be very strong. Silver's what I'm going to get into. But it's just the unloved child at the moment.
Correct. So in the last month, if you look at silver in US dollar terms, it's fallen about 13.5%. So silver has fallen 16 days in a row, and silver mining stocks have been completely smashed. So now I haven't been particularly concerned about that. I mean, some of the movements in commodity prices are a result of the in terms of the increase in interest rates. So I would say a couple of things. I mean, the first thing is there's obviously a big debate in the precious metal space about whether these prices are free, whether these markets are free and fair, whether the price is the natural price, or whether we have systemic price manipulation. I mean, I'm in the manipulation camp, and funny enough, only in the last week, Kitco News of all places aired an interview with a wealthy investor in the mining sector, who basically said gold, because previously this is Frank Gistra, who used to say that gold is managed. Now he's saying out and out gold is manipulated, and it's actually hurting in terms of investors. So for those who are new to this space, people need to understand the history of these markets and who sets the price and whether the price is fair or not. And if you believe that the price is not a fair representation of demand and supply, well, what are the implications from that? And so I've obviously, as the chief economist, been looking at these issues quite intently for the last 4 or 5 years, and I think there's a lot of upside potential, particularly in silver, given the macroeconomic forecast. So all I say is that when the prices of gold and silver go down like they are now, I look at this as a buying opportunity, and I'll continue to buy gold and silver at cheap prices. Now, what would make me sort of exit the precious metal space? It's largely if I see a complete change of approach by central banks and governments around fiscal and monetary policy, but also prudential policy in terms of the bank. So if we started to see politicians talk about inducing a depression, deflation, having responsible fiscal and monetary policy settings, I will change my portfolio allocation. But so far, on the evidence that I can see, it makes sense for me and my family to have an inflation hedge portfolio, and we'll continue along that path.
And so we spoke about silver. But has there been any particular reason for silver to be going down for 16 days in a row? Have you got any view on that? Because gold has sort of held its own for the moment, hasn't it?
Yes. So gold has been down a bit, but and the other thing I would say is that even with gold and silver, their falls are nothing like cryptocurrencies or speculative stocks. So I mean, is there a particular reason why silver should fall for 16 days in a row? I mean, there is no sort of logical reason other than the price is set in New York at the COMEX in the futures market. So I mean, the only thing that would make sense is that they're responding to this initial flurry of interest rate rises, which would be negative for commodities, and silver is responding along those lines. But the only thing I'll say is that one of the analysts from North America who I subscribe to is Ed Steer. Ed has put out a interesting newsletter last week saying that the Commitment of Trader reports is particularly bullish in terms of silver. a lot of the big four commercial banks have reduced their short position, and that generally when they do that with a relatively large open interest, it looks like that they are preparing for the price to come back up. So, there could be a few more days of silver going down, but I'm thinking that there's a lot of videos out across YouTube in the last 24 hours which suggest that silver is likely to rebound, particularly with gold. But given that silver has been hammered quite a bit in the last month, that we could see a healthy rebound in the short order.
John, I gave a wry smile a moment ago because you mentioned cryptocurrency, and it wasn't something that I associated with you. Cryptocurrency, do you follow it? Do you like it? It's been smashed. Is it gone?
Well, yes. So I'm not a big follower of cryptocurrencies. I don't have any sort of investments in cryptocurrencies, so to speak. My long-term view has been, taking a leaf out of Warren Buffett's book, is you should invest in something that you understand. Yeah. And so, to my mind, there's two core bodies of knowledge that you need to know in order to make an intelligent decision in cryptocurrencies. One is some basic economic concepts, monetary economics as well, but also cryptology, because how do you assess the likely potential of a project, and obviously, what are the risks if you don't understand what these projects do, what's the purpose of these various cryptocurrencies. So, for me, if you provided me with the Bitcoin code versus Litecoin versus Ethereum or Ripple, etc., I just wouldn't know exactly what these projects do and actually how, at a technical level, to independently assess what the risk and reward equation are in terms of some of these cryptocurrency projects. So now, some people who have an IT background do have that ability, and obviously, if they do, they have the expertise to pick and choose what are the right projects, and they can profit from that. But unfortunately, a lot of retail investors have just jumped on the bandwagon because they see a lot of people making exorbitant sums of wealth. And let me just give you an example. I had lunch with someone last week who in 2015 invested 250,000 Australian dollars across a number of altcoins. And in the last 6 months, he sold them all out and walked away with $1.75 million. So he's made, in the course of about 4.5 years, $1.5 million, which if he was working, there's no way he'd be earning that sort of money. So for those people who have dedicated hours upon hours, they have made it work. But unfortunately, one of the reasons why the cryptocurrency prices have gone ballistic is because you've had a lot of latecomers. And even only yesterday, CNBC published an article saying that 40% of Bitcoin investors are underwater. So a lot of these late entrants into the market have lost a lot of money, whereas obviously a lot of the early investors, whether they came in before 2017 or whether they came in late 2017 after Bitcoin had crashed, those investors have actually made money. So and again, as interest rates tend to increase. One of the big claims of cryptocurrencies was that it was a non-correlated asset. Well, the evidence that we have seen in the last couple of years is that no, cryptocurrencies is highly correlated with the stock market indexes, particularly in terms of the tech stocks. So as tech stocks and the general share market falls, we're going to see cryptocurrencies fall, and obviously late entrants into the market, whether they've put a small amount or a large amount of capital in, they're suffering horrendous losses. And Bitcoin's fallen 55%, but there's a whole bunch of altcoins that have fallen more than 55%. And the real big question on the crypto space is that once we reach this pause and pivot by the central banks, will investors come back into crypto, or will they go into commodities? So if we think about, for example, the 1970s or what happened after 2001, people switched to commodities, and that's why we saw long-term bull markets in gold and silver. But there's a real big question: is that going to happen moving forward, or are these investors going to go back into cryptos and avoid the commodities? So there's a bit of uncertainty about what capital allocation investors will do, starting at the end of this year, early next year. But that's going to be a fascinating thing to observe as we move forward.
John, we're going to get you back on in a few months' time to just have a look back at what we've talked about. But now we're running out of time. I'd love you to just give three comments or three opinions, three things that you think our community should be doing right now to, as I said before, protect and potentially grow their wealth. What three pieces of advice would you give our community right now?
Sure. Well, I mean, so the first thing to realize is, no matter who wins the federal election in the next week and a half, neither of the major parties are going to actually resolve the inflation problem. The only hope is if you have more independent and minor party politicians who have different ideas about that sort of question. So I think focusing on the current state of politics after the election and getting a feel for, is this going to be the status quo in terms of what we've seen over the last few years in terms of how Canberra operates, or are we seeing a new paradigm? So I think that's point number one. Point number two is obviously, like I said before, to the extent that you can build buffers, cash flow management in terms of debt, in terms of whether it's stockpiling non-perishables and some of those other things, just to give yourself a bit of leeway. That I think is quite important, and particularly if you have a mortgage and you're seeing significant cost of living pressures. I mean, middle class families are going to get squeezed in that, and then obviously if you do have money to invest, obviously come to your own independent assessment about whether we're headed to deflation, inflation, and then obviously allocate your capital according to what your medium-term perspective is.
Well, John Adams, Chief Economist, As Good as Gold Australia, it's been fantastic to talk to you today. And the thing that I've taken away from this, ladies and gentlemen, is from John, invest in what you understand. Do your own homework, do your own research, but invest in what you understand. But you must invest because right now we are in turbulent times, but also make sure that you are diversified. John Adams, thank you so much for joining me on Small Caps today.
Thank you, Kerry.